I've been using Monte Carlo to help wealthy families plan for their retirements for 25 years. It is an excellent tool. However, there are 4 ways that Monte Carlo can fail during your retirement. I've met with over 300 wealthy families throughout my career, and I've seen a number of instances where Monte Carlo has failed. That empirical data set is what I draw upon for the information that I'm about to share with you. Here's what a standard Monte Carlo forecast looks like. You run 1,000 trials. Most financial planners will focus on the median ending value, the 500th trial from a Monte Carlo simulation. In addition to a graph like what you're looking at that shows all of the simulations that worked and those that didn't work, you'll get a probability of success with the simulation. Your Monte Carlo forecast will come with a probability of success just like we're looking at here. This is typical of what you see in most financial plans. What this means is your 76% odds of success equate to 766 out of 1,000 Monte Carlo forecasts trials succeeded for your specific data. But let me show you 4 ways that Monte Carlo can fail you during your retirement. The first way that Monte Carlo forecasting can fail your retirement plan is ignoring sequence of negative returns risk. Sequence of negative returns risk is extremely high. It's 97% likely that if you are retired for 30 years, you will experience a sequence of negative returns event at some point during a 30-year retirement. But in my experience, many people just ignore this risk, or their financial planner brushes it off and doesn't focus on it and explain it to them properly. Why is this a big deal and how does it fail? How does it cause your Monte Carlo forecast to fail? Look at this example. We're looking at a Monte Carlo simulation here. Look at the investment return column. You can see that there are 2 back-to-back negative years, very serious, minus 32, minus 33. At some point during a 30-year retirement, you're likely to have something like this happen. The losses might not be as severe, but the issue with sequence of returns is that when you get 2 negative return years back-to-back, or even 3, like we had in 2000, then you're going to lose more money than you probably expected to lose. Most financial plans are set up with an asset allocation that focuses on 1-year volatility. But sequence of returns will usually exceed your downside threshold for losses. In other words, you're going to lose more money than you expected to lose. And here comes the problem. A lot of investors will panic, especially if they're retired, when they see their portfolio drop by a large amount, more than they expected, and they will cash out. And once you cash out, throw your financial plan away. It's over. I think what happens is that most people just ignore the losses that we see here. Look at the ending portfolio value. It's 2.2, then it's 1.7, then it's down to 1.3. And I think a lot of people convince themselves that this just isn't going to happen. And the financial planner doesn't really spend any time explaining to the person that, no, this is very likely to happen. It's just a question of when, not if. It's very likely that you're going to have a couple negative years at some point during your 30-year retirement. And will you stay invested? That is the key. A lot of people won't. They panic and sell. Here are the stats on sequence of returns risk. Since 1871, there have been 125 30-year investment periods. 122 of those periods had sequence of negative returns event risk. Only 3 did not. So, based on the past data, there's a 97% likelihood that you will experience a sequence of negative returns event at some point during a 30-year retirement. And when that happens, will you stay invested or will you abandon your financial plan and sell out? Because if you sell out, your Monte Carlo just failed. Here's the most recent sequence of negative returns event. It happened 25 years ago. The year 2000, 2001, 2002. 3 negative years in sequence. None of these years were particularly bad. -9, -12, -22. And for most people, any one of these years didn't violate their risk profile, right? on any given year. If you lost -9 and your asset allocation, your risk tolerance were set up to, say, not exceed -20 or 25, something like that, well, you are within your risk parameters. But 3 negative years in a row caused you to be down 40% or more for some people. And that is what catches people off guard. And that is when they throw in the towel and the Monte Carlo fails, because you are losing far more than you ever expected and you panic and sell. The second way that a Monte Carlo forecast fails is having an asset allocation that does not fit with your risk profile. For example, if you went into 2008 and you had a portfolio that was more aggressive than you understood, if you didn't understand just how much it could lose, the peak to trough loss in the 2008 slide was 56%. It was painful. And for many people, especially those who had a financial planner who was not that well versed in investments, or they themselves didn't understand the potential for losses with their investments, when the market crashed, many people got scared and sold out at the bottom. Then they missed the rebound. Once you sell, the Monte Carlo forecast is worthless. If you want your Monte Carlo forecast to succeed, then you better really understand what this means. Everybody has pretty pie charts in their financial plans, but do you understand what's in the pie? And does your financial planner understand what's in this mix? Unfortunately, many don't. There are no barriers to entry in financial advisor land. Anyone can call themselves a financial advisor. It's not hard. Anybody can get in this business, no barriers to entry. So you want to be absolutely certain that both you and your financial planner really intimately understand your asset allocation, your potential for losses under bad market conditions, so that you stick with the plan. If your financial advisor isn't talking to you about the risks of Monte Carlo forecasting, please give my office a call. We would be happy to give you a second opinion on your retirement plan. The third way that Monte Carlo forecasting fails is if you get out of the market. Monte Carlo forecasting assumes that you stay invested 100% of the time for the entire duration of the plan. But for many people, this is just not possible. And generally, it's because of the two reasons that I just showed you. Number one, people ignore sequence of negative returns risk. Or number two, their asset allocation is more aggressive than they realize. They don't understand their investments, or their financial planner doesn't understand their investments, or them. They were not thoroughly profiled. Whatever the reason, if you get out of the market, your Monte Carlo forecast just failed. Especially if you get out of the market when the market is way down and then you don't participate in the rebound. That really messes up your plan. So if you want to succeed with Monte Carlo forecasting, you have to stay invested for the duration of your plan. I know this talk of abandoning a financial plan and a market downturn seems alien to many of you. It's been 16 years of an amazing bull market. But trust me, we're not too far away. It's probably only a few years before we see another recession and probably a serious downturn. It's been a long time. We're overdue. And when it happens, will you be ready? Do you really understand your investments? Can you really tolerate serious losses? If you are approaching 65 years old right now, you were in your 40s the last time we had a downturn. You probably didn't have nearly as much money. So if you're 65 and you're getting ready to retire and you've got $2 million, $3 million, $7 million, are you willing to tolerate serious volatility? Does your asset allocation stand up to serious volatility? Are you confident in that? You want to be 100% sure so that you stay invested and your financial plan works the way you expect it to work. The fourth way that Monte Carlo forecasting fails your retirement plan is incorrect assumptions. Garbage in, garbage out. It's easy to mess up a financial plan if you have incorrect assumptions, especially if you spend more than you plan to or you didn't save as much as you planned to, or maybe you didn't get the amount that you thought you were going to get from your stock options, from your restricted stock units, from the sale of your business and things like that. So you want to make sure that you're conservative with your financial planning and that you revisit the plan often over the years so that you can have correct assumptions and stay on the path to success. Retirement is not cheap. There will be unexpected expenses during your retirement. If you're cutting it close, this can create a lot of stress, a heavy drain on your portfolio, and violate your Monte Carlo simulation, your forecast. The best way to handle this is to overestimate your expenses, have a great budget, and underestimate your future cash flows coming in. You want conservatism with your plan. That all leads to a much higher likelihood of success during your retirement. If you like this content, please share it with your friends. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.